Okay, we are live. Welcome everybody to our Lunch and Learn. I am Diana Renee and I am here with Tommy Evans of Arbor Financial. And I'm super excited to have him. He's an amazing lender here in California, Southern California, Orange County, Riverside County, LA County. I believe, Tommy, you handle them all. Yep.
Yeah, all of California.
Awesome. So today, we are going to talk about today's real estate market and how to get your offer accepted, how to proceed forward with the financial side of things. Also, some of the perks that are coming up in lending that the Biden administration is putting down, the current current environment in regards to inventory and understanding the competitive nature in the market. If you have been looking for a home and putting offers in, you probably have a taste of this. It's been pretty crazy and a very challenging market for buyers. Amazing for sellers, but well, let me caveat that it's amazing for sellers if you have somewhere to go, right? If you have to purchase another home, then you're in the same position as the buyers that are looking at your home. So at any rate, welcome, Tommy. We really appreciate you joining us today. This is a lunch and learn. So we're going to talk about what we're having for lunch. So I always try to support the local businesses here in Corona. So I ordered an acai bowl from Acai Republic here in Corona. Very healthy and tasty snack. And they also have gluten-free options.
Well, hey, thank you for having me today. I really appreciate you bringing me on here. And yeah, I ordered food from Playa Mesa, which is, I live in Costa Mesa, so this is a local Hispanic restaurant, and their food is absolutely incredible. I would have also had the margarita, but a little bit too early for that for me today. But they do have margaritas that they offer up that you can actually take to go. So it's been one nice thing about COVID is there's been a lot of creativity within the restaurant industry and getting more food out there, and it's just easier. So I've got a family plan since my whole family is working from home and homeschooling. So you'll probably see one of them run by in the background. I apologize in advance, but yeah, so we're going with the family plan today.
Awesome. Well, I just want to say it's 5 o'clock somewhere. Just saying. So again, welcome everybody. If you're just now joining us, we have Tommy Evans with Arbor Financial. Hey, you guys, if you have any questions for Tommy, just throw them out there. We can see what you're putting in the chat and we will respond. So we would love your interaction and your input. And don't forget to like our Facebook page. We have tons of valuable info on there. So yeah, and we would again just really love to hear from anybody. So Tommy, tell us what got you into the mortgage industry.
Yeah, so I actually have an engineering degree. I went to Oregon State University and worked as an engineer for several years after college. And it was just one of these situations where I was back home and I was up in Oregon living in Portland at the time and came back home and just happened to run into some old friends and they were all in the mortgage industry and doing extremely well. At the time, they were making about the same amount per month that I was per year. And it caught my attention and just so happened that they were hiring and I was offered a job right there on the spot. And so I gave up my engineering career and moved down to Southern California from Oregon and really never looked back from there.
Awesome. Did you grow up in Oregon?
No, I grew up here in Orange County in Tustin, and I played soccer, collegiate soccer, and so I had always liked just the idea of getting out of Southern California and getting up into something completely different, and boy, was it completely different. The rain and the weather is what makes it so green and beautiful up there. And so yeah, I spent the entire year up there, summer jobs, kind of getting myself through school, and just loved it up there. It was a great experience.
Yeah, that's awesome. Well, again, welcome. So one of the topics that we wanted to talk about was the current environment in regards to inventory. So I know that you are very on top of following the numbers. We've talked about that before, and I really appreciate that because the numbers really tell you the truth of what's going on as opposed to just having an opinion. So I'm interested in your input from the lending side about what you feel is going on and where you feel the market is going.
Yeah, so inventory is at historic lows. We are hovering at right around 1.3 million listings, and to put that in context, the average listings that we kind of want to see is like right around 2.5 million. A lot of recently we've been hearing all this talk about housing bubbles and housing crisis, which I do not think anything is supported in that regard. CNBC was just 2 days ago, spent the entire day talking about how unaffordable homes are, and it's just not true. And so you look at what happened as far as, with the last housing crisis, we had 3.9 million listings at that time when that housing bubble started back in 2007. And so, or 2009 basically is when really things got ugly. And so right now, everybody that for the most part has taken out a loan has been able to qualify for it since the housing crisis. And so, it's not like we're going to have the same effect where, you look what happened. You were able to get 125% financing with, literally just a, 540 credit score, and never even bringing in the fact that you didn't have a job and you didn't have any money. You got a loan. So it's not like there was any wonder that there was a crisis after, the lending practices that really helped drive that. We're not in that environment. If you look at the statistics, you have, but basically is about a quarter to a third percent. It's roughly a third percent of the homeowners nationwide. A third of them are investors and have them as rentals. The other 2/3 are people that are actually living in their homes. Of those 2/3, about 25% of those are owned free and clear. And then the other about 60% have 60% of those that have mortgages have less than 50% loan to value. And so people have tons of equity. And so it's not like people are just going to start selling their houses and create all this massive inventory. And then on top of that, the other thing that's really playing into this is the forbearance that's going on. And so I think what is happening with the forbearance is a good lesson for everybody out there. I mean, we just had 30 million people that got laid off of work over the last year, and you don't see a massive influx of short sales and foreclosures. So in fact, nobody's selling. Everybody's staying in their home. And so this has been a really good lesson that forbearances actually work. It's better to keep people in their homes. It's cheaper. And just today, you saw Citi and Bank of America release their earnings. They are extremely profitable. I think 8.1 billion for Bank of America, and it was like another 7.9 billion for Citi. And so there isn't anything that's pointing that this forbearance is an issue as well. And so and then on top of that, things are going to get even more difficult if you're a home buyer right now. So there's a lot of statistics that are out there that are going to prove that inventory is going to continue to be low. And what I'm referring to is there's a couple of interesting facts. One is the average homeowner, first-time home buyer, is 33 years of age. If you go back and look at the birth rates 33 years ago, 32 years ago, 31 years ago, 30 years ago, the birth rates are increasing over the next 5 years. And so there's more and more first-time home buyers coming to the market. Now that's one of the factors. The other factor is that the majority of these people are also, you look at people starting out families. So of age group 30 to 39 years of age, you have basically 20% of those people that are single are homeowners. Now, once they have a kid, it goes all the way up to 80%. Just one child, the home ownership jumps up to 80%, right? And so if you look at the baby registry that's happening right now, so if you just Google baby registry, there is a massive increase in people that are starting to register for kids. So what that tells you is there's going to be more and more people that are having kids, more and more people that are looking to purchase homes. And so I think the reality is that we're going to continue seeing inventory shortage for several years to come, and it's all supported by the figures that are out there. Sorry about that.
Okay, I would tend to agree with that as well. Just demographically, we are headed into a shortage of homes. We have a quick question from our audience, and then I wanted to talk about the foreclosures. First of all, thank you for joining us, Terry. We appreciate you. Terry had a question. If you want to move but have to sell your current home first, is there a way to purchase your new home before selling your current home?
Yeah, so there's a couple different ways that you can go about that. There are loans that allow you to do a blanket loan that will cross collateralize the home that you own with the home that you're purchasing. You can actually put 0% down if you've got enough equity in your current home. You can go. They'll allow you to go up to a combined 70% loan to value. And so they'll take the value of the home that you're in, plus the home that you're looking to purchase, whatever you owe on that, plus however much you need to have on the home that you're purchasing. So it is possible to literally put no money down on that purchase. And then once you sell your property, then you have one of two options. You either go and do a loan recast, where you take those funds and put them into the mortgage and just drop down both the principal balance, and they will re-amortize it based on that new balance. And then the other option is, if the rates are just lower and you can do something better, you just do a refinance and you take those funds, or however many of those funds that you'd like to put into the property, and just do a refinance. So those are the best ways out there.
So is that a bridge loan, or is a bridge loan a different product that you're talking about?
It's considered like a bridge loan. Yeah, which you can also take out it's a type of bridge loan, basically. Yes.
And how are the rates on that? They're a bit higher, right, than a conventional? Or
They are, but depending on your credit, you're going to be in like the mid fours if you've got great credit, which historically speaking is amazing compared to the 3% rate that you can get, or even sub threes that we're hovering around right now. Obviously, it's not as good, and so that's why the key right now is getting your offer accepted. There's a lot of options once you have that house. Who knows, maybe you can put your home on the market and sell it so quickly that it closes before we're able to close this one, and we can actually kind of switch directions midstream. But if you don't get your foot in the door, anything trying to sell contingent right now has a little bit more headwinds. So that's obviously important to give yourself the best chance to succeed.
So if I'm assuming that Terry's asking this because people are nervous, right? They don't want to put their home on the market and sell it before they found a new property. The other thing I would say, Terry, I'm not sure if that is why you're asking this, but there is a contingency called a seller contingency. And what that means is that your property, your current property, does not close escrow until you find your new property. A lot of buyers are willing to wait like 2-3 months even for you to be able to find a new property before you actually close escrow. Also, there's rent backs where you rent the property back. There's seller in possession. So talk to your realtor about that. If you don't have a realtor, I'm here. But so yeah, there's options. And then along with the option that Tommy had mentioned, there's a lot of ways to kind of put you at ease.
Yeah, and just on that topic, if you are contingent on a sale, like you said, there's so many ways to protect, yourself as a seller. You can have, buyers are willing to do just about anything. I just recently had a buyer that removed all contingencies. We were able to get, loan approval. We had everything was clear to close. We were just waiting for them to get their replacement property. And so when, as a seller, you can go in and say, hey, look, I've got a fully approved loan. Contingencies have all been removed. They are just waiting for me to find this replacement property, and they'll be ready to close in as little as a week. And so that's one of the ways that we can help to, position you guys.
Okay, here is another question. Why do realtors often refuse showing properties without a pre-approval? That is a really great question, whoever asked that. So this is the deal. And it's, you know what, it's true in every market, but even more true in this market. Without that pre-approval, you literally cannot put an offer in. Like as a listing agent, we won't even look at offers for my client without that pre-approval letter, because what that shows is that you actually can purchase the property. So wanting to purchase it is just simply not enough, right? You need to have a pre-approval letter from a reputable lender saying, yes, you can purchase this home. And that way the seller knows that you're really serious, and it gives you a better chance of getting your offer accepted.
Yeah, and I literally just had a referral from another realtor that I work with, and they asked me to pre-qualify this buyer, and he basically came back and he's like, well, don't you just need a pre-approval letter? And he refused to do the pre-approval. And so I went back to the agent and explained to them that here was the conversation. He said he was going to complete the application. 10 minutes later, he called me back and said it was too much work. And she didn't even consider his offer. And so it's right out the door. And, the thing that buyers need to realize is that if you are serious about buying, you have to be prepared. You have to have your documents ready to go. You need to have everything submitted to the lender, your income, your assets, because a lot of these pre-approvals that they're asking, they also want to see the DU approval. And the only way you're going to get that is by pulling credit, by having the loan officer review all of your income and credit and your assets to know that you actually qualify for that house. And so, agents don't want to waste their time right now. They've got too many people that are trying to get their, make offers. I mean, it's, as you can attest, it's pretty insane out there right now.
Hey, Tommy, quick question. We do have another question from someone watching. Just hold tight. I'm going to ask him that. But my question is, you mentioned DU approval. Can you explain to everybody what a DU is and why it's better than just a pre-approval letter? And just so you guys know, it's a little bit more work to get the DU, but like Tommy said, you really want to stack the deck in your favor in this market. So really, the more you can do to prepare for that offer, the better chance you have of getting it. So that said, Tommy, if you could just explain to everyone what a DU is and why they want it.
Yeah, so basically you're looking at an automated underwriting system. So it's the AUS. And so there's two different ways to go. You can go Fannie Mae, which offers the DU approval or desktop underwriting. And then there's the Freddie Mac side of that, which is LP, loan prospector. So those two items offers different, slightly, there's a little bit of tweaks that one is better than the other. For example, if you're self-employed more than 5 years, running through Freddie Mac, you might only be asked for 1 year tax return as opposed to having 2 year tax returns. And maybe 2019 wasn't so great, so you can throw that one out. Now you're getting qualified with just 2020 tax returns that look a lot better. So these are some things that are little tricks that we're able to pull, and sometimes one is better than the other. But it's really important that you yourself as a home buyer know exactly what's going to be required of you, because sometimes depending on what your situation is, there might be something on your credit report that you didn't know about, and maybe there's a lien on there that we have to get removed, a tax lien, or there's something, a collection that might need to be paid. And until we actually run it through this automated underwriting system, we don't know for sure. So you want to know as a home buyer exactly what you can qualify for. So it's not only important just to say, okay, well, I can do 5% down on a $500,000 purchase because that's how much money I have. But you also have to keep in mind that there's also going to be closing costs, and there's going to be additional moving expenses, like how much you actually need to set aside. So it's really, really important to know your numbers. And one other topic on that is knowing your credit, and so I spend a lot of time with my clients helping them go through credit. One of the great things you can do is go to Experian Credit Boost, and sometimes you can boost your score just 20 points. And that's the difference between getting a loan, or maybe it's the difference of paying $100 a month in mortgage insurance versus $200 a month in mortgage insurance, because you're able to take your credit score from a 699 to a 740, let's say. And so these are some of the things that we look at. And the more time that I have to be able to work with you, the more time we can spend putting you in that best position. And so a lot of times that's us paying down some credit card debt, doing the credit boosts, and there's a lot of tricks that we can help recommend to put you in that best position. And let's say you had something that was derogatory on there that wasn't even yours, that you didn't even know about. Now you're going to have to go and start working to get that removed, and that all can take time.
So Tommy, would it be fair to say that a DU means that you're further along in the process?
Absolutely. Yeah. I mean, basically there's those that just, say, hey, I had a conversation with a lender, and, based on the information I gave them, everything looks good. The next step is they actually, you sent over your income documentations and assets. They looked at that and say, hey, everything looks good. But in order to actually get a DU approval, you have to have your credit pulled. We have to run everything through, the system and make sure that it all checks out. And that's the next step. And then there's even a step after that you can actually get a fully underwritten approval, where we can take that and submit it to an underwriter and have them review the file as well. And so that would be like a fourth step almost.
So that's great information, guys. If you are looking for a home, getting that DU approval, super, super important. Definitely, like as an agent, when I see that, I know that you're a little further down the line and more qualified than someone with just a pre-approval. We did get another question, Tommy. As a buyer, what fees do we pay to get pre-approved?
That's a great question. There are zero fees that I charge my clients to get pre-approved. And so that's one of the best things out there, is that there is no cost to it. I don't know anybody, quite frankly, that does charge any fees to get pre-approved. And so, we pay for your credit up front. Some lenders will charge a fee for their credit. To me, that's probably a good sign that that's probably not someone you want to be working with, to be honest. So I would say, if somebody does start asking you for fees, you should probably talk to somebody else.
Okay, another question. So what loan programs do you have available for first-time home buyers?
Yeah, that's a great question. And one of the best one that's out there and is a mortgage credit certificate. So this is a tax credit that offers a dollar for dollar tax credit, which is different, from a tax deduction. A tax deduction, you actually get to kind of reduce the amount of your overall tax liabilities, but a tax credit is a dollar for dollar reduction in the amount of taxes that you pay. So a perfect example is if you were to pay $10,000 in mortgage interest, you get to write off 20% of that, which is $2,000 per year that you're going to have as a tax credit. And so that is by far anybody that can get approved for that program. You do have to be a first-time home buyer, which means you haven't owned a home in the last 3 years. There are income and basically like about $153,000 income limits. And then the limit on the home buying, I want to say is like 751,000 right now. So most home buyers, first-time home buyers can take advantage of this program. So that is a great one. Now there are down payment assistance programs that are out there. Getting them accepted right now is kind of a little bit of a challenge, but the way I spin it to the listing agents is like, hey, look, let's say they have 5% down, but if we can do this down payment assistance program, if the appraisal does come in low, they're going to have this extra money that they're going to be able to access and apply with this program. And so the big ones out there are Cal HFA, which offer actually a 3-pack. So they offer a first mortgage that typically is in the high to, high 2s to low 3s, depending on if you're looking at conventional or FHA. The second is at 2%, and that's for up to 3% of the actual purchase price that you're going to be. So now all of a sudden you're at 100% financing. And then they also have, you can either take a third mortgage that's either at 2% of the loan amount on the first or 3%. You have an option. The difference is the rate on the first mortgage is going to be higher depending on which one of those options that you go. But you're essentially getting 3 loans, and that third loan is at 0 interest. So it's called a ZIP, zero interest program. And that is a great program for a lot of first-time home buyers. There's also GSFA, which is the Golden State Financing Authority. So they have 2 really good programs, Platinum and Open Doors. And so those are really the best programs. Now, there are some local programs, depending on where you're looking, that, each city, there's a lot of cities that have their own program that we can look into to see if you can get a grant to help you qualify. So I'm happy to discuss, we can get into each city and see if there's something that works better for the individual.
That's great. Really quick question. So you mentioned in order to qualify, you would be a first-time home buyer, which means you hadn't purchased a home in 3 years. So does that mean if you had purchased a home, you sold it, and now 3 years has gone by, you could qualify for that program? Is that correct?
That is correct. And so the way that they verify that is they look at your tax returns for the last 3 years to see if there was any mortgage interest deductions. And so as long as you had 3 years, you're able to qualify as a first-time home buyer.
And then you mentioned an income limit of 150,000 per person. Is that per couple or per person?
So it slides. So for 1 to 2 household, it's 150, and then it goes up from there. Whether you've got 4, 6, 8 people living in the house, and so it adjusts. And so we can just look at what your individual situation is to determine how high we can go on that income limit.
Mentioned a limit of $750,000. Does that change based on county, or that's just a blanket?
No, it's a blanket. It used to be by the county, and so they did change that, and so that has recently, as of like 2 years ago, they did update that.
And one more on the first-time home buyer. Is this the Biden tax credit, or is that something that's still kind of coming down the road? And I know they haven't completely solidified that yet, or have they?
That's something completely separate. Yeah. So, And quite frankly, the tax credit is probably the worst thing that could happen to, like, if you think inventory is bad right now, you're throwing in a tax credit and trying to get more home buyers out there when there's zero inventory. Like it makes no sense that they're doing it, but that's, beside the point. But that is a separate item that is coming down the road.
So we're running a little short on time here, but there are a couple of questions that I wanted. So we're going to go over just a little bit, guys. So there's okay, I would like to talk about how interest rates affect your payment. So we kind of touched on earlier about how CSNBC ran the news show about how houses were unaffordable. So I just want to talk a little bit about how the low rates can change your payments drastically, right? And depending on what you're doing with that home, like your goals are what's really important. Is this your forever home? Are you living there 30 years? Are you trying to turn a profit, buy it, flip it, sell it? That all makes a difference. So Tommy, if you could speak to just how those rates affect the payments for people.
Yeah, so just January 4th, we were hovering at about 2.5% interest rates. And as of today, we're right around 3%. So we just had this happen. We went up 0.5% in just 4 months, okay? And so what does that actually mean as far as payment goes? And so for every eighth, you're talking about on let's say a $500,000 loan, you're talking about $34 per month in payment. So for 0.5%, that's just bumped up $136,000 or $136 per month. And what that equates to is about a difference of about $35,000. So in other words, if you were to take a loan out of $35,000, you'd be paying about $136 per month. And so you're looking at real movements there. And I do believe we're going to see another move higher with the inflation numbers. There's actually, you're literally about to watch this happen in April. So this is really, what they're looking at is the consumer price index, the CPI. The reading and how they do it is they do a rolling 12 month average. And so they just had last March, they just had the increase of 0.3%. And so what they did is they replaced last March's reading of 0.1%. So now we had a net increase, right? We're about to replace a negative 0.4% from last April of 2020 and probably replace that with about another 0.3. So that's 70 basis point swing in inflation that you're going to see in one single month. And May is very similar to that. We're going to see another, probably 30 to 40 basis point swing. So overnight, you're going to have the inflation figures skyrocket over the next 2 months. And inflation is the arch enemy of bonds, and which really what drives rates are the mortgage-backed securities. And so mortgage-backed securities are basically fighting inflation is the one thing that they really don't like, because you're talking about 30 years that you're holding on to this money. And so the last thing you want to see as a bondholder are, inflationary numbers. And so you're going to see rates spike up over the next couple of months. But what's going to happen, and what I do believe is going to happen, is once you start seeing everybody, they call it when the masks come off, right? When everybody starts going back to work and things get back to some normalcy and these vaccines take place, we're going to see probably in the next, following 6 months, the Q4 into 2022, we're going to start to see these inflation numbers taper back down. So I do believe that we're going to see rates come back down in 2022, but we're going to continue having issues with the inventory. Inflation is going to spike over the next 3 to 6 months, and then that is going to taper back down, I believe.
Okay, thank you for that. We have another question. Since home inventory is so low, would it make sense to look for a lot and build your home? Do you have any information about lot inventory for sale? Yes, I do have information about land. So if you would like some to know what's available, please reach out, send me a private message and I can send that to you. This one's for Tommy. How does a construction loan work? And it's interesting because I have had quite a few clients calling about land. So land is getting hotter. I think in part it's because of that. Exactly. People are, they're struggling to find a home. So they're willing to do it themselves. But what does that look like, Tommy, to get a construction loan?
Yeah, so a lot of the investors that I personally had for construction loans, once COVID came, they just pulled the plug on them. And so I've got one investor that is literally just coming back into that space. And so ultimately, the way that the program that I had that I do believe is coming back is that they don't offer a lot loan, but you could, if you have plans to build that with approved plans with the city and have everything, permits and everything ready to go, you can then purchase the lot and have that construction financed into it. And so for that one, it was 30% down payment for the total project is what I needed. And they were willing to go 90% on the acquisition of the lot at the close. And so that's the program that I had available that I do believe is coming back. Outside of that, getting a lot loan, I only know one place to get them personally, and that's at US Bank. And I've got a contact. If anybody's looking to do that, I can get you connected with the right person.
Sharing that.
With that said, what I'd say is even a better route to go, I would go with, there's a suite of renovation so there's 3 different options. One is conventional. The second is a VA renovation loan. And so if you're a veteran, you can get 100% financing. I actually just did this for my now neighbor. They purchased a home for $720,000. They put $110,000 into it. It's now worth $1 million. This was just 2 years ago they did this. And so the house actually didn't qualify for traditional financing. So that's the key here. It's like you're looking at finding that beat up, terrible house that the only way that it could qualify is a cash offer, right? So now you're competing against cash offers. And so you can come in a little bit higher. With the conventional financing, you can put as little as 5% down. And then there's also a third version, which is FHA, which you can do a 3.5% down. And so renovation is in my mind, if I was looking for a house, that's what I'd be doing. I would really focus my attention on the worst house in the best area and that needs a ton of work, that probably doesn't qualify for conventional financing because it's got so many issues. That's what in this market, that's what I'd be looking for.
Okay, thank you. So, hey guys, if you're just joining us, be sure to like our Facebook page. Normally we go till 12:30, but Tommy has so much info. We're going to extend it just slightly here. Please ask your questions below and we will get them answered for you. And thank you for joining us. Last question, actually I have a whole bunch more, but this one I feel is important because when COVID first hit, lending tightened up so much. They got rid of jumbo loans. They got rid of banks' stated income. But guess what, everybody? Both of those are back. So jumbo loans are back as an available loan product, which Tommy can speak to in just a moment. And then also stated and no income loans are back as well. However, there are some caveats with that, which I'll let Tommy explain both.
Yeah, so we'll kind of address the jumbo market first. And so one of the best things that's coming out is, as the credit market, kind of loosens back up again and investors are feeling better about, the housing market, we're seeing, all these programs that disappeared are coming back, and the pricing is actually coming back with them as well. And so I've got jumbo financing, 10% down with no mortgage insurance, that you can do up to a $2 million loan, which as you know, in Riverside County, the loan limits are only $548,000. So anything above $548,000 is considered a jumbo financing. And so you can go as low as a 680 FICO. Debt to income ratios go up to 45%. So this is a great product, and we're going to continue seeing more and more of these products. I actually just got an email this morning that there's a 5% down jumbo product coming out. This is with a non-QM space, which is, let me talk to you a little bit about the non-QM, which is a non-qualified mortgage. And so this is not a Fannie, Freddie type loan or even a jumbo loan. These are non-traditional loans. Not to say that we're doing loans like they were doing back in 2004 through 2007 that caused the housing crisis. These are loans that a lot of times for that 5% down, they're going to need probably some pretty good credit. I haven't seen the actual guidelines on it yet because they haven't come out yet. But for these non-QM loans that we're talking about, no ratio type loans, for example, there's two different ones. And so when we're talking no ratio, you don't put any employment information as far as any income on the loan. In fact, there's two different types you can do. So the first is for investors. And so we just looked, it's called a debt servicing coverage ratio. So it's a DSCR. So as long as the mortgage is paid for by the rents, that loan basically can be serviced by the rent. So for whatever reason that person can't continue making the payment, the bank knows they're going to be covered by the rent, so they're okay issuing these loans without having any income for the investors. Now that's one great product. Now something to consider there is that the down payment is going to be more than 20% in most cases, 25 to 30%, because you got to be able to make it so that it pencils out. Now, the next loan that you referred to is a no ratio for owner-occupied loan. So this is I just closed one of these 2 weeks ago for a self-employed borrower who has just a ton of write-offs, and on paper it didn't look great. So they brought in 35% down payment, didn't put any income on it at all. And so it's literally a no ratio loan where we don't even look at your debt to income ratio. That doesn't matter. It's essentially based on the equity that you're putting down and the credit. Now the bank statement products are out there. These are going to be priced much better than these no ratio loans. And so if you can show consistent deposits into your bank account as a self-employed borrower, that's going to give you some better pricing. And then there's a non-audited P&L, which is also slightly better priced, where you don't have to have like a CPA create your P&L and do a full audit on it. You can create the P&L yourself as long as it's backed up by the bank's statement deposits. We can use that as qualified income as well. And so these products are coming out, and they're all some of the bank statement programs you can do as little as 10% down if you've got good credit, but most of them you're in that 20 to 30% down payment range.
Awesome. Well, thank you, Tommy, so much for all your information today. We appreciate it. Hey guys, if you are looking for more information on the market, the lending market, real estate market, looking for information on loans, Tommy is amazing. As you can see, he's very well versed in what's going on. He's very well versed in what's going on with the real estate market and lending. So please reach out to him. His information will be below. I have worked with Tommy multiple times, and I would personally recommend him as somebody that you could go to help you with the purchase of a home or an investment property. Thank you so much for joining us. We have these lunch and learns every month, second Thursday of the month. So we'll be having one again next month. Please like our page for more valuable information on the real estate market. And as always, if you're looking to buy, sell, or invest in real estate, give us a call. We are happy to help. All right, everybody. Thank you so much for joining us, and have a wonderful rest of your week. Bye.
Thanks for having me. Appreciate your time.
You're welcome.